So for your auditor's report, was it a clean opinion? How do we know?
So what do you need to know? So the first thing that I just like always as a prerequisite to answering or to discussing this topic is understand what kind of service you're getting from the accountants. I would say 95% of the time, at least what we're doing is we're auditing the financial statements. But there are two other levels of service that are common, especially in buildings that might not have a mortgage or a smaller property. Sometimes we have co-ops and condos of 5 units, 10 units. They don't need an audit per se. So they'll do, what's called a compilation. So a compilation is exactly what it sounds like. We compile the numbers together. So we're compiling the numbers from management into a set of financial statements that looks like an audited financial statement, but it's not audited. It might have footnotes, it might not have footnotes, and just check that first page. So usually there's a cover page with the accountant's name, and then there's a page after that that'll say, either independent auditor's report or independent review report or, letter from the accountant. See what kind of service your building's getting. Because again, if it's not an audit, they're probably doing less. It also affects, the fee. So if you're paying a lower fee for different, compilation review work is not as high level as an audit. An audit is much more extensive. There's more that's done. So just first, take a look at it, see what you're getting. If you're getting an audit with no disclosures, then that's a problem. And then obviously if you're paying a lot of money for a compilation, maybe you should upgrade it to an audit. But again, we don't need to go into those details. It's just kind of understanding the different levels. So compilation is just really kind of sticking the numbers together on a statement. Review, there is some analytical work that's done. So we will compare items to the budget, to last year, but we're not digging into checking balances, checking internal controls like we do in an audit. And then the highest level is an audit. So just kind of understand what you're getting from your accountant as part of that. And then when you do get, if it is an audit, there are 3 to 4 different reports. The one you want is B, unqualified. That means there were no issues. The audit was fine. We may have some comments, but that wouldn't be on the audit report. That would come in as what's called a management letter. Qualified means now everything was good except for one thing, and we qualify that. We're going to put that in a little paragraph. A disclaimer is like a step worse than that. We found something more, and an adverse is that I think I can't remember if we ever, because I don't think we have ever issued a qualified disclaimer adverse opinion on a financial statement. The only thing that comes close to this is if you notice a lot of the buildings, and this becomes a question that new board members, new owners ask, is how come there's this disclaimer about the future repairs and replacements not being disclosed. So if you look at an audited financial statements for a New York City or New York City co-op or condo, most of the time, unless there a study of future repairs and replacements was completed, you will have this disclaimer that it wasn't done. So it's not, in essence, that's not a negative thing. It's more that you don't have an official study, so therefore we're not putting it in the statements. We could talk about that, if we have time at the end. I don't want to suck up too much time about that. But if you see that, it's not a bad thing. It's just more of common practice in the New York City co-op and condo market that we don't advise putting that in the statements. But that would be the only thing you get close to a disclaimer that I've ever seen on my end. So again, just kind of take a look at the statement, see if it's comprehensive. Look if there's only one page of notes on a 350 unit condo or co-op. There's probably a lot more going on than one page of notes. We technically have, traditionally we'll have at least 3 to 4 to 5 pages of notes, depending on how extensive the building is. I'm not saying that you should necessarily, change it, but understand kind of what what you're getting from your accountant and whether or not you could, explode the notes a little bit more and have a little bit more information there. Again, the reason you want to have a little bit more, and this is my last point, is because who's getting the financial statements, right? The shareholders, the owners, potential buyers, the lenders, the banks are getting these. The more you have in there of quality material, the less questions they may ask. And it tells a story. The financial statements tell a story. And the more you have, the better you could tell the story with obviously not going into too much detail. You don't want us to be a whole book. The better is that you'll get less questions from let's say someone's trying to buy a unit in the co-op and they have all these questions because there's nothing in the notes. So you kind of want to balance that level because what's required, what's helpful, and what's excess. So kind of look at those things. So that's what you should look at. That was our fourth points after cash, receivables, and whether you have a surplus or deficit. And talking about the audit report.